let's get some perspective. Ed Yardeni at Yardeni Research is now joining us. Ed, good to have you with us here. Good morning. What should we start with? Let's just start with what's happened over the weekend. I mean, it's not new, but the scale of it, of course, is very large. It's a very old conflict. How would you read this, and what are the implications for markets according to you? Ed, I think you'll have to unmute yourself, Ed.
So you're right. Sorry about that. Can you hear me now?
Yes, please, go ahead.
Yeah, I apologize for that. Clearly this is a horrible situation, and the human toll is awful. In terms of the financial markets, I think in the past we've seen a knee-jerk reaction where the stock market's down and oil prices were up, and we're already seeing that in the futures markets. I think that much will clearly depend on how long this lasts. This one could last a while. It really depends on the extent to which the Israelis go into Gaza and try to root out Hamas. I mean, that could take a long, long time, and it could become a very protracted and a much bigger war if the Hezbollah up in the north starts launching rockets. And then, of course, Iran and Israel could wind up getting into the fray of this whole thing. So I would not get, I think we have to wait a little bit. I don't think that the geopolitical consequences of all this are easy to predict. This one may be different than some of the short-term problems we've had in the Middle East. So caution is probably the correct way to approach it.
Caution is the correct way to approach it. Got that. Ed, hi, good morning, and thanks for joining in. Of course, it is a horrific situation that is playing out before our eyes. So keeping the human emotions aside, if you just go by history, right, in hindsight, for an investor sitting in India, global or geopolitical issues have always been the best buying opportunity, just because of how far out we are in terms geographically.
Yeah.
Do you think this time could be different, or should one use this as a buying opportunity in a market like India?
Well, India is a significant importer of oil, so much will depend on the price of oil. But as we've seen just recently, before this conflict started, the price of oil went up and then it came right back down. The demand is very sensitive to the price. And so we have seen that once you get up to $90, $95 a barrel, you do get demand destruction, which brings the price back down. So the risk is that this will become a much wider conflict, and that Iran's production will be impaired dramatically. But on the other hand, the Saudis would probably start to pump some more. So I think that, the markets right now, the reaction isn't as bad as one would think. The stock market futures for the S&P 500, or the Dow, I should say, down about 200, which is certainly not much of a reaction. The oil price can be very volatile, and I also don't think that's going to stay up. But I think for India, this too shall pass, as this has in the past. And I think the fact that India is remotely related to any of this, other than through the price of oil, makes India a candidate for some area of stability on a global basis.
Hi, Ed. Good morning. The last time we spoke, you were telling us about maybe it could be wise for the Fed to pause in the near term, going by, what we're seeing in terms of economic data as well. What did you make of the jobs report? First look at it, it looked red hot, but then you looked at the wage number and you said, hey, it's not that hot, and that's, I think, what the market grabbed onto out there. How do you expect the Fed to move from here on?
Well, I think the Fed has to recognize that the economy, while the economy has still been very resilient, they don't want to push this thing too far. I mean, if wage inflation is coming down, and if we get a decent CPI, I think the expectations is 0.3%. Could be lower if the rent inflation finally comes down. I think inflation is coming down without a recession, if that's the case. And I don't think the Fed wants to should push this thing too far. The other thing to recognize, that the Fed needs to recognize, is that this incredible increase in the bond yield is already a form of tightening. The bond market's doing a lot of the work for the Fed from here on. I mean, let's face it, 10-year bond yield is close to 5%. is really quite a disaster for commercial real estate. So we've had this rolling recession that's now rolling through commercial real estate, and I don't think the Fed really needs to do any more.
So before we let you go, Ed, you're saying that it's better to be a bit cautious now, even for a market like India. But given that this too shall pass, one should be looking at some interesting buying opportunities here. Is that the right way to look at it?
I think that is the right way to look at it. Here in the U.S., I think that, once we get some idea in the next few days of the extent to which this is going to remain relatively contained, I think the good news is that we're entering our third quarter earnings season. The good news, obviously, for the financial markets, not geopolitical, but the earnings outlook is pretty bright. I think we're going to have better than expected earnings for the third quarter, and that may very well allow the market to maybe hold its 200-day moving average here for the S&P 500, and then set us up for a year-end rally if things don't totally blow up on a geopolitical basis.
Okay. Just one quick last word, Ed.
Sure.
So yields went up 7 basis points on Friday. The S&P ended, the NASDAQ actually ended about 1.5% higher as well.
Right.
So how do you square that, both those things?
Well, I've been thinking about that quite a bit, and we're going to do more work on it. But I think a lot of these big cap NASDAQ companies are less exposed to interest rates than one would think. I mean, everybody knows that growth stocks are supposed to go down when interest rates go up. But what if those growth stocks don't have much debt compared to other stocks? And I think that's part of the story here, is people are recognizing that the mega cap 8, for example, just don't have that much debt and aren't that exposed to higher interest rates.
Okay. All right. Well, that's possible. Absolutely. Thanks very much, Ed. Good speaking with you as always here on CNBC-TV18. Appreciate you joining in with all of that perspective. We'll take a very